Hello and thanks for joining us at interest.co.nz. I'm Janae Tibshirani and today I'm joined by Reserve Bank Governor Adrian Orr. Hello, Governor.
Kia ora, Janae.
On Wednesday, the Reserve Bank announced that it was going to be increasing its quantitative easing or large-scale asset purchase program. You said that you'd increase the cap from $60 billion to $100 billion and also extend the time frame from May 2021 to June 2022. Now, Governor, this decision was made before we had the bad news about community transmission of COVID-19 in New Zealand. Do you think this news will prompt the Reserve Bank to buy these bonds more quickly, so increase the rate at which it's buying these bonds from banks and investors and others in the market?
Yeah, thank you, Janae, and very good question. I'd say, the final decision was made on yesterday morning, so we were aware of all of the information to that date, which included the level 3 Auckland, level 2 elsewhere. Our decision, though, remained consistent that we needed to do an enormous amount of further work around easing monetary conditions, that our baseline scenario has still had downside risk to it, and that news, as we heard, which was incredibly disappointing but not unexpected to many people, really just goes into the wash of the uncertainty we're dealing with. So it's there was no immediate impact around the quantum or the pace around what we will be doing in the large-scale asset purchasing, but it has helped remind people that we are dealing in a world of scenarios, being prepared rather than a world of prediction. And so the scenarios around ongoing rolling COVID challenges, which are locally, regionally managed, really sits at the heart of our mahi, of our work ahead of us to keep those interest rates low.
Okay, so you said that you'd front load those bond purchases. You won't be front loading them more aggressively now that it looks like New Zealand will go into some form of lockdown.
Well, really, it's about us getting our feet wet. We've already, we deliberately announced our weekly purchasing earlier than usual. We wanted to make sure the market knew it was going to be more than usual on a weekly basis. Really, the pace is going to be a function of what impact are we or aren't we having on the actual yield curve. Are we maintaining and lowering that yield curve as best as we can? In addition, what is happening to the total supply of bonds on offer? So this is a task where we need to keep moving just to stand still, and so we want to be. Yeah, sorry.
Continue.
We want to be at least keeping pace, if not outpacing, the debt issuance, which is a function of the fiscal policy and what they're putting out. We're saying, well, these are the assets we can choose to purchase. We're purchasing them with the idea of keeping interest rates low. So if there's more available, we can purchase more and try and keep that interest rate level low. So the pace is not about drawing a straight line between now and June 2022. That is simply the length of the indemnity we have. The pace is going to be a function of the impact we need to have on interest rates.
Okay, and talking about that availability of bonds there, people who were paying attention on Wednesday would note that the Reserve Bank and the Finance Minister agreed to increase that limit from 50% to 60%. So this means previously the Reserve Bank could buy 50% of the bonds, New Zealand government bonds on issue. Now that's been increased to 60%. Do you think that that's actually the final limit where that ends, or is there scope to potentially go a tiny bit further in the future?
Well, I mean, there are operational limits that we would need to find, and that operational limit is going to be really defined about achieving our purpose without creating any dysfunction in the government bond market itself. And by that, it means that we don't want to crowd out other people's ability to hold bonds, to buy and sell bonds, because that's an important, relative price, a price of the relative risk of New Zealand government debt versus the rest of the world's government debt. So it provides a good signal. We think leaving at least 40% of the bonds on offer out in the market, should we at the moment, I think we're only about 20% of the bond market. Should we reach that 60% level, the 40% is still a deep liquid pool, and it's still a pretty small percentage of debt to GDP in a sense. So, you know, there's lots of scope for us. Theoretically, you know, we could take 100%, but that is, you know, that's a theoretical optimum. We're working around a sense of an operational optimum, which is going to be a learning curve for all of us.
Do you think the market would be too disrupted if the Reserve Bank ended up buying 70% of those bonds on issue?
Too early to tell. You know, it really is. It's going to be what you know, just from my own personal experience over the years. Very often, the New Zealand market, the debt market, is a flow driven. So the weekly level of purchases will have quite a significant impact up or down on interest rates. So it's not just the end level, but it's the pace at which we are doing it. You know, we're not going to be here so that we exactly meet some level in 2022. We're going to be managing that pace where it's as predictable as possible week to week for market participants, but it's for our purpose. It's not to keep market participants happy. It's to achieve the interest rates we want for Aotearoa New Zealand. And so we will be prepared to alter it to get the impact we need.
Okay. Governor, yesterday the bank outlined fairly clearly that once QE starts to reach its limits, or I guess the next cab off the rank in terms of the tools that the bank has to employ to meet its inflation and employment targets, would be to cut the OCR into negative territory. But interestingly, combine that with some sort of term lending facility to banks. The tone of the discussion yesterday was that those two tools would be quite linked, or that they would work quite well together. Is the bank pretty firm on those two things, if they were to be being employed at the same time?
Our first best choice would be to employ at the same time. I'm going to be really careful and honest. I don't want to rule out optionality because you know, we live in a very dynamic, uncertain environment. But, you know, to our best efforts, we want to be able to have a very well calibrated, designed package of instruments. We want to have it where people understand what it's about. People, as you, like yourself, are able to communicate around what it does and doesn't mean. And we want to make sure it's operationally ready as well, so that not just here at the central bank, but also through the financial system, not even just banks, the system as a whole, understand and can manage it. So a package is better. We're talking about a package in coming months, really in the sense, not because we think QE or our large-scale asset purchasing is reaching a limit. It's simply that it's better to have a combination of instruments that doesn't put an overburdening pressure or unanticipated distortion on any one part of the market. So a combination of lower official cash rate, of an additional funding mechanism for banks at that official cash rate. They know they can come to us to fund their lending. They know they will be incentivised to lend rather than just hold it in their vaults, as well as the bond purchase is a far more palatable around bank profitability, about incentive structures to lend, and about interest rates people receive on the streets.
Okay, look, correct me if I'm wrong, but since the onset of COVID, the Reserve Bank has implemented a bunch of kind of policies, kind of like term lending facilities, to encourage banks to lend more. And some of these have actually been at a rate below the OCR. So with this new facility that could be implemented, would that be at the OCR level, or could that also be below the OCR?
We'd be at the OCR, or if not, with a small margin. And I agree, there's been an enormous amount. It's been acronym soup out there around both the activity we as the central bank have been doing, on top of what broader government, the whole of government, have been doing. So I'd hate to sit the acronym test, but there are kind of two parts to it. The first part, around a lot of what we were doing initially, was making sure that the financial market has a window here. They can come to us for liquidity purposes. So that was to make sure that the open market operations work well for government debt, local government debt, and also for corporate paper. That they always know there is a buyer or lender of last resort called the Reserve Bank that will keep the liquidity and prices working. Even if they're not being tapped, the mere fact that they're there in the background provided an enormous amount of confidence to see markets start to behave normally again. The other set of instruments, the ones we've just talked about, are around trying to affect the level of overall interest rates and the exchange rate in the economy, rather than just keeping the market operating. So for that level, those instruments are going to be around funding banks at or near OCR, and working to keep the overall level of the OCR low and the yield curve low.
Could there be a bit of a decoupling of the OCR rate and of other sort of wholesale market funding rates?
I would say so. I mean, at the end of the day, all roads, at least at the shorter period of the yield curve, will always come back to the official cash rate. We have the monopoly ability. We bank the banks and we can set that price. So there will always be the official cash rate anchoring the short end of the yield curve. But as you move further down, these instruments are going to impact in different ways down that yield curve. And you get so far down the yield curve that even our near-term activities are going to be lost in the wash around the global market's expectations of global growth and what it means for New Zealand. So our impacts are mostly around, the day one through to, year two type impacts.
Okay. With that term lending facility, do you think it will be tied to another type of program? So, for example, the Reserve Bank might say, okay, bank will, provide you with this facility, but there's a condition on it. Like you have to lend the money to businesses or whatever. Have some condition on that lending?
I would like to say they will be incentivised as opposed to instructed to on lend, and this is the important. This is why we're talking about it so openly now, because a lot of that calibration and getting that right needs to be done with the banks themselves, and also with people like yourself, so that you can hold, you can understand and put the transparency on the whole program. Part of it would be, you could, as an example, you could come to us, you'll get your term loan, but you'll get top-ups or replacements as a function of what you've actually on lent. And so that's an incentive to be on lending rather than just stocking up your retail bank balance sheet with this cheap funding at the cost of other forms of funding. So it's an incentive structure to on lend. This, by the way, it's the best form of flattery. We're busy looking at what other central banks around the world have been doing and where that has been successful and where they've come up against problems. So we're in a great position. We've got the time. We're going to be working with the banks, and we'll be calibrating what works for our system.
Okay. Look, just finally, big picture stuff. People, reading the sorts of news that we're writing about this, and one can't help but think that the monetary policy system we have really does help prop up asset owners and the housing market potentially. Keeping those interest rates low, that benefits people with mortgages, with debt, doesn't benefit people who don't own anything. So, what would you say to that? Is this really kind of good for everyone, or just good for the rich people?
I'm very pleased you've brought this up, Sinead, and I think the way you've put it there on the table is exactly right. The really interesting point, just before I answer directly, the really interesting point is that we tend to hear from those who have got large cash surpluses in their bank and have assets. They're saying these low deposit rates are crimping my lifestyle. Yet really it's those who have the assets who are benefiting the most from this type of lower interest rate. Where do the benefits come through, and what are our balances? The first thing we need to balance, of course, is what is the single biggest concern we have for meeting our mandates, plural, our mandate around low and stable inflation, full employment. So that's what we're aiming at, and I would have to say that higher than necessary unemployment or a significant economic slump is the worst outcome for everyone involved. So we're involved in trying to make sure that outcome doesn't happen. We're also balancing that against financial stability. There are short-term financial stability issues. We're trying to keep the cash flowing, people able to pay, all of that work. Lower interest rates achieves that. It enables cash flow throughout the economy. Some may benefit more than others. They might have more debt than others and so on, but cash flow gets improved. Everyone in that sense is better off. Particularly that debt far outweighs savings in the New Zealand banking system. So, but in the longer term, you know, in the very long term, you can reach these corner solutions where asset prices are so extreme, no one believes they're ever going to be held up, and you end up with volatility in asset prices. That is not our challenge, our purpose. We just have to be aware of that. And people, when they're out making those investment decisions, have to be open-eyed, aware of those types of activities. So that it's a global challenge, but you know, we are heading off the first and most important worst possible outcome, which is a significant recession, deflation. Deflation is terrible if you own debt, because the real cost of that debt is rising every day.
Sure. Just quick question finally. Modern monetary theory, how would you describe it in a few words? Loopy, or does it have some sense to it?
I describe it as non-modern in the sense that it really is the same monetary theory that has existed forever. It has evolved through to the institutional structures we currently have. The institutional structures are really just a subset of what could be monetary theory as a whole, just as is modern. And the real difference is simply the separation of government deciding fiscal policy and monetary policy keeping inflation low and stable through time, through institutional separation. That's not necessary, but it's proved highly effective. You can achieve both if you needed to, but there are very different risks, operational and reputational risks that exist.
Sure. Reserve Bank Governor Adrian Orr, thank you for your time. And I'm Janae Ticciarani from interest.co.nz.